Welcome to the Apartment Guys, where we dive deep into all things multifamily investing. Our mission is to educate, inspire, and empower real estate investors to reach their highest potential. Each week, host Tate Seymour interviews high-level guests from all over the industry who are sure to bring valuable, actionable ideas that will propel your career to the next level. Whether you're just starting out or a seasoned investor, you are in the right place. And now your host, the Apartment Guy, Tate Seymour.
Welcome everybody back to another episode of the Apartment Guys podcast. And today I'm hanging out with my buddy, Max Gonzales. Max, welcome to the show. I'm really stoked that you're here.
Tate, it's great to be here, and it's good to see you again.
Yeah, likewise. So check this out, listeners. Max began his career in the multifamily industry in 2003, working as a broker with buyers and sellers in multifamily real estate to achieve their investment goals. In 2006, Max began working with Fowler Property Acquisitions, and he oversaw acquisitions for Arizona, Southern California, and Nevada for office and multifamily properties, where he acquired over $85 million in assets. Starting in 2017, he led multifamily acquisitions for Pacific Urban Residential, an organization with over $9 billion in holdings, and he was in the San Diego market where Max saw the acquisition of over $430 million in closed transactions. That is really amazing. Large value add multifamily and core plus multifamily acquisitions. Through his career, Max has worked through each aspect of the real estate acquisitions process, including acquisitions, dispositions, PSA negotiations, underwriting, debt structuring, construction management, asset management, and due diligence through a successful close, of which he has closed over 3,200 units. So Max, that's awesome stuff, man. That's a really impressive bio.
You know, Tate, I appreciate that. You know, the great thing about knowing guys like you and being part of the investment community now is that all that stuff is great. The thing is, though, is when you're working on the corporate side, it's not your money. Mm-hmm. And that's the, and that's the big difference with, working for a corporate shop versus, starting out and saying, hey, I want to build a portfolio for myself. I want to get my own equity. I want to have my own equity built in long-term holdings for deals. Mm-hmm. Because, the corporate side, where you talk about these big transactions, doing a lot of acquisitions for groups that are putting out big sums of capital, they structure their business model in a very different way. And in many ways, it often felt like I didn't work in real estate as much as it felt like I worked in investments. Where we're looking at very specific coupons on cap rates, arbitraging cap rates against, whatever current debt we can get or stabilize the asset at, and what kind of basis point spread we could get against those things, which is all fantastic. It's a great experience across the board. And the reason that I left the corporate space was to build my own net worth with my own investors and to go out and actually feel like I was on the real estate side again of actually growing personal equity. Mm-hmm. And, in the community, for your listeners and for everyone who's out there and they're looking at some of these big transactions, and how that space is run, it's run totally different. And it's an awesome place. And, and I loved it. And I've got a ton of, wonderful advocates, across the board from the commercial space. And, now that we're looking at, now myself and my partners, we're looking at smaller assets in growth markets, across the US. And it's been, a totally different ball of wax. It really has, which is why I'm, stoked to be connected with guys like you. Really. That's
great. That's cool. So smaller assets in progressive markets. Speak a little bit more to that. What does that specifically look like?
Sure. So, so what that looks like in regards to, building a portfolio of deals is we're out and we're finding assets that we can, you can see my dog in the back. She made a little dog. I can't let her know. That's Mishka. But, though, now we're looking at buying deals, we have to, go out and raise capital for them. And that's the difference between the corporate side, and the individual side is, if you got to go out and you've got an existing sum of money already readily available to be placed in the market, then that's something that can be done, relative, I'll call it, it's easy to have the blinders on, hey, this is the return you have to hit. These are the buildings that hit that particular investor's criteria. A lot of real estate capital to an outsider, it might look like it can go towards anything, but really it's very, very specific, where you've got, specific investment funds, pension funds, equity advisors who are putting out capital. And the reality is that each of those individual funds has a very, very, very defined box where that capital is going to go. Mm-hmm. And many pension funds that might have several $100 million worth of holdings, they'll have their capital very divided between, stocks, bonds, real estate. If you were to divide up that real estate even further, you'd see it segmented between, retail, multi, industrial, office, hospitality. And within those spaces, on the corporate side, what ends up happening is they say, all right, well, hey, here's the capital. We want you to go out and want you to place it. Well, that makes it really easy because then you can really narrow in on exactly this very niche type of business model, and you can really drill in and find out what's a good deal. And when I talk about these different markets in the US, there's great real estate to purchase everywhere in the country. And people say, well, is this market a good market? And the answer is, well, if you know that market well enough and you know what the market cap rates are, or what the price per unit on the upside is, and you have very specific market knowledge, you can find a great deal in any of those locations, as long as you're able to really drill down and say, hey, this is the reason I know that this is a good investment and that this other one is not, or whatever that criteria is. And now when we talk about growth markets, we're looking for assets where we are for building this portfolio, where we have to still go out and we have to go to, the investor base and raise capital for these deals. And we're focusing on assets that are priced up to about 15 million in locations where, for multifamily exclusively, that are generally 1980s and newer built. That's very specific due to structure of the space. 1980s were the years that assets became a little bit, the construction standards became better. The ceiling heights got higher. There's no more lead paint. A lot of the units have washer dryers attached to them. Yeah. You could have walk-in closets. You can immediately look at the 70s building and recognize, the old venting for AC, the closet sliders supposed to walk-ins, the low ceiling heights. Those are all things that, all those units have value. But when you look at a long-term hold for a building, the younger buildings, 80s and newer, they're going to have a little bit of longer term value. Mm-hmm. And we're looking for assets that we can purchase now, renovate to be able to get up to, a stabilized market cap that generally we try to hit between about 75 to 125 basis points over the in-place market cap, and hopefully hold for as short as 3 years out to about 10 years. If we're buying a core plus deal, that's, I'll call it a well-located deal that we're happy with. I'll call it a good cash flow we can get by beginning of year 2. That would be, really ideal.
Mm-hmm. For our listeners' sake, this is really high level stuff, and I'm loving it. I'm taking all kinds of notes here. Explain what a core plus property is. That's not something that we've talked about much on this podcast.
Sure. So, when you talk about risk within investment classes, you're going to have generally a scale. And the rule of thumb on the whole is going to be that assets that require more work should pay you a little bit more on a return basis. Mm-hmm. And on a return basis, someone says, well, how much is a return? And, you look at that based on the best way we can describe in the industry is based on a cap rate. If a core property, and a core property is going to be one that for this conversation, I'm going to describe as a new building. Okay. You're in Salt Lake City. There's a brand new building that goes in down the street. It's 100 units, and you see it, and everyone looks at it and goes, wow, look at that great new building. The building's got new appliances. It's got new electrical systems. It's got new plumbing. It's got a new roof. It's got brand new designs. And it's got things that, just to say, for an owner who's going to hold that building for, say, 10 to 15 years, maybe 20, none of those things are really going to break down. They're all going to be in pretty darn good condition over the course of that 20-year period. If a buyer buys it sometime between year 10 and year 20, this owner, he knows that during his hold period, most of those things are going to need repair and replacement. There's going to be a little bit of disruption. That's what I'll just call it, disruption. All right. The building's not quite as new anymore. It's still a great building, but at 20 years, you've got a building that's got 20 years of newer built buildings that are around it. Those are the new buildings competing for the highest rents. It's got new designs. And we say new designs, you can tell when you go into a building. If I go into a building now, I see it's got granite countertops, rounded edges. I'll call it a pine or maybe a mocha espresso cabinet box. It's got flooring that's, the style that was made from that time. You can tell it was an early 2000s build because those were the materials that were really hot during those years. Right now, it's quartz countertops, often gray, shaker cabinets, square edges on the counters. These are things that become very identifiable within designs and do transition from a building that's built now to whatever is the thing, in 20 years from now. The core buildings are brand new. They're the best thing that's out there, and they're expected low disruption as a result of that from a cash flow perspective, meaning that an investor who goes in is expecting the building to run pretty darn standard, meaning that you're going to underwrite it. The rents are at a certain level. There's not going to be much that's going to break down. At 20 years, now all of a sudden, you just know, hey, we're going to have to replace out these appliances. We're going to have to replace out the refrigerators, the roof we're going to have to fix. And that's what the building is kind of considered a core plus. And these are described very specifically in regards to a risk profile. Mm-hmm. And on a high level analysis, when you're talking about, say, a pension fund or a life insurance company or a credit union, one of these groups that needs to put out capital, their money is going to be adjusted on what they're going to put out based on the risk profile of their money going out. Mm-hmm. And they might say, can you talk about things like a 4 cap or a yield on cost? And for some of these groups, they care a lot more about asset cash flow preservation more than they do high side gains. Meaning, you buy a core building, that brand new building that's downtown Salt Lake City. Well, the reality is that building probably is not much you can do to it to really, I'll call it, make the returns better. You buy a value add building. A value add building is a little bit easier. Yeah. Hey, we're going to renovate these units. We're going to move rents up $100, $200. Now we've got a building with a better cash flow. Now the building is worth more. But that core building doesn't really have that opportunity. It's a little bit capped in how good it can do. Mm-hmm. But those particular investors aren't concerned about the upside. They're concerned about minimizing the downside. Right. They already know that they're going to get a good cash flow. A building that most likely is going to continue appreciating in market in a supply constrained industry. And as a result of that, they look at it and they go, okay, great. We bought a 4 cap. We're going to put on a low loan to value on it. We're going to get our yield up to a 7%, maybe an 8%. And for many of those groups, that's enough. They say, hey, we put our money out and it's a better return with no downside risk compared to the stock market. And that's what's considered a good return. Mm-hmm. And in that risk adjustment sense, core, low risk, not much to do. Core plus, a little bit more to do, expect a little bit better return. Value add, well, all of a sudden now we're at a point where, we're expecting a higher return because there's more work to do, a little bit higher risk, but nowhere near as risky as the stock market, I'll call it.
Right.
And really a business plan that has to be written to kind of adjust for the renovation scope within that unit. Hey, what are we doing here? Hey, we're going to do quartz countertops. We're going to shaker cabinets. We're going to redo the clubhouse. And what do we get for that? We get this return, whatever that number is. Maybe it's a building has even a heavier value add, where you look at something and it's, had some really severe issues. You got an owner who really neglected the property forever, and it's a heavy value add. Mm-hmm. Well, then you've got a bigger construction project. You've got potentially a year to 2 years, depending on how big the deal is, to get it turned. And that might be such a high risk that some investors might look at that and go, hey, look, you've got a business plan here that is, on par with almost development. If I'm going to do a development project, I'm going to expect a high return because, I'm not getting cash flow for, a year to 2 years. And I need to have, a higher return if my capital is going out for this risk. So that's kind of I'll call it a high level view of core plus, value add, and heavy value add as far as, what the return profile should look like.
Appreciate that. That's very well laid out for myself and for the listeners. Core buildings are almost these days anyway, are almost always going to be Class A. Would you agree with that?
Yes.
Yeah. Because nobody's building Class B anymore.
Building Class B. The best way I can describe it is that risk profile. If you've got a brand new building and it's studio construction, but it's in a market where you're expecting good rental demand, what it is, and but it's still studios. That doesn't make it not a core building. Okay. My description very specifically in core is in regards to minimizing risk on a institutional level of investor capital.
Yeah, makes total sense. Awesome, good stuff. Okay, so zooming back out a bit, you have a lot of experience with other asset classes inside of real estate, retail, industrial.
Some. I've touched a little bit of them over the course of my career. My focus has been very focused in core plus and value add.
Okay,
so I can talk about them some, but
core plus value add is always going to refer to multifamily asset class.
You can apply them to other spaces.
Okay.
Some of the other spaces in regards to the institutional space is going to have a little bit of a different view on those in regards to what the risk profile will be. Multifamily is it's become such a commoditized industry that it's the one that's probably the easiest to actually kind of, I'll put it on par with, well, I shouldn't really do that, but I was gonna say a bond coupon where, you've got these AAA rated bonds,
Right.
they're looked at upon as very, very secure.
Right.
And multi has such an industry behind it. And what I mean by that is it's gotten so big and it's gotten so detailed that it's definitely the location where those terms are probably the most identified. You could still call a brand new retail building, a core investment, but a lot of those projects are often construction. I don't want to call it as a build to suit, but a lot of the groups who build malls, it's generally not a one-off group. It's usually some very, very professional, high organization groups that do that. Industrial can be similar, and some of that might even depend on the leases. A triple net lease could be considered a core holding, I'll call it. If you've got a triple net lease for maybe an Amazon, Amazon might bail on the lease, but if you're doing many investors.
Or
say again,
well, I was thinking Starbucks. That's more retail, but like a reliable tenant is what you're getting at. A
AAA credit rated tenant,
yeah.
Who that is renting a location. That's an example of a secure hold that could be considered like a core. And in that sense, where you're buying it, and and if you were to use those terms with someone, they would be appropriate. But I'm talking very specifically about multifamily, just because that's just what I know the best.
That's what you know the best, and so that answers my question as to why when you went into developing your own portfolio with your partners, why you've specifically focused in on multifamily. Would you say that you're focusing in on smaller assets? Now, let's get back to that definition for just a quick sec. When you say smaller, what kind of unit count are you?
For us, we're small. It's such a relative term. I would say anything from about 2 million up to about 15 million. Is smaller, and some of those can really range. And there's no, anyone who thinks that bigger deals are more glamorous, they're just different deals. There's different deals. You got there's a lot more people who might have to be paid as a result of doing bigger deals. There's more hands-on involved in these assets.
Yeah,
I know a lot of guys who have made 7-figure checks on an asset that was 16 unit building. They got it, they bought it right, they were able to turn it and resell it.
Yeah,
a lot of the guys who were doing assets on the high level, talking about a lot of these large corporate transactions. A lot of large corporate transactions, a lot of the staff, they might be paid in equity, they might also only be paid in bonus. Which is not the reason a lot of us got into the industry. We got into real estate because we love the product type, and we like, having equity and having long-term cash flow in these deals.
Right.
And on, small to large, my partner and I were just working on a deal down in San Diego. It was a 16-unit property. I'll leave the details of this off as they might actually already be closed. It was 16 units. It was a $6 million valued asset. It was $375 a door in San Diego County.
Wow.
It's a big number. And we're looking at it, and big number, again, it's relative in comparison to another building that I was looking at in Kansas City. It was 96 units. It was $70,000 a door.
Right.
And approximately 6.2 million.
Right.
And we're looking at these two properties and we're comparing them, and our partner and I are looking at them. We're going, we got this one here in Southern California that we got, this number, we're getting 16 units. We got this one we're looking at in Kansas. That's, 96 for, close to the same price. And the equity check that gets involved in both is a little bit the same. And this goes into, where the investor base is going to be comfortable with investing capital. And do they want to invest in an asset in California that's a little bit more supply and demand driven? Meaning it's not a good value, but in California right now, the market is very, very dependent on, actually, there's many markets like this in the country right now where the demand is outpacing the increase in rents. And we are seeing an increase in rents on a national basis. That is due to inflation and many factors nationally. But we're seeing that, and a lot of the investor demand is outpacing a lot of the current increases that are happening for rents.
Mm-hmm.
So, so smaller assets, we are trying to target assets that have, I'll call it, a limited amount of capital raise and work for us to do. And I mean that very much in the sense of, growing a portfolio. I've learned a lot from, doing this business side, from literally, no joke, your podcasts, these other podcasts that are out there, because, you talk to these guys, and my understanding of real estate on a high level, was something that I had a lot of experience in for years. But this last year has been a very big learning curve for me on how to find new investors who are looking at putting their money into assets. And a lot of those institutional partners, I was previously mentioning for large deals, those are very, very large groups who put out a lot of money with very, very established large organizations, because they got to really be sure that their money is being well protected. And they should be. They should have that goal. Our focus is to build a net worth for our investors and ourselves. We want to grow the net worth of our investors so they keep investing with us. And we want to be able to buy assets that we can, that we have the manpower right now to take down and be able to work through on an investor basis. So for the most part, we have access. It's so funny when I talk to brokers, they say, well, how big of a transaction will you do? And we've got access to some deeper pockets of capital. For right now, my partner and I, we're looking for stuff that's 15 million and under. And that's very specifically because we have the manpower right now to be able to work through those things with no problem. We can do multiple of those a year.
Nice.
And that works out for what we're looking at right now. For scaling up, we got this to go work through first, and then we'll work on that part next.
Yeah. And I love this conversation. And it's one that I've had multiple times recently, starting with David Tupen, who was on, I think, about 5-6 episodes ago. And I don't know if you know him or know of him, but he's young. He's like 27, 28, and he's been doing it for like 6 years now, and has done very, very well, and has taken, I think, 6 or 7 deals full cycle. And
that's great.
Yeah. And he when he went back and looked at all those deals, he realized kind of the same thing that you said you saw with your friends, where he's making 7 figures on 15, 20 unit kind of deals. And when you're looking at something, he was all about, for the longest time, he was all about, like, the more units, the better, right? The easier the deal is to do, the bigger it is, the bigger, you can find the bigger, it's easier to find the $5 million checks and the $1 million checks, or the $10, $100,000 checks. Like, you hear that sort of thing a lot. But really, at the end of the day, it's all about your balance sheet. And if you're having to split up a deal a zillion ways because you've got a preferred equity source or something like that in the deal, or a capital raiser, or et cetera, like, you're making a lot less on that deal because you're dividing the pie up that many different ways, right?
You're dividing your pie up that many different ways. And there's also what I'll just describe this as, it's there's a lot of brokers out there who are in the mid-market space, sub-institutional is what I'll call it, where, you might have certain deals in certain markets where you've got guys who are doing, and actually, maybe I'll even use another example. Residential agents, by far and wide, and there might be people who are going to, be upset to hear this, make way more than the commercial agents.
Oh, interesting. Yeah.
And there are commercial agents that make massive tens of millions of dollars a year. And there are residential agents who make that much. And on the net, I would say that the commercial agents, it's hard to stay in the business, because with residential, there's a lot of agents who don't do that many transactions within a year, and there's some that do all of them. And in the residential space, you've got a lot of these guys who just do more business because there's just more product available. And within the commercial space, there's not as much product as there is in residential. And as a result of that, you've got a smaller industry across the board where you've got, fewer guys in each market. Each market most likely has between, I'll call it 10 and maybe 30 guys who really control the majority of the business. And you can find that in most major metros in the US. And the guys who were at the top, the guys who are often selling institutional deals, maybe 100 million and up, they're going to have less deals than the guys who are doing the mid-market space. And I don't want to use this as a hard rule of thumb, so no one calls me and gets upset about it. But a lot of the guys who do business where they say, hey, all I'm doing is deals that are 5 million to 20 million, they might have, 3x as much business as some of the guys in their same market that are covering larger product types. And the fees for the larger deals, they get compressed. If you're in an asset, 5 million and under, you're probably going to have to pay a broker between a 3 and 5% fee. Right. You get up to about 20 million, that fee is going to go down to about 2.5%. If you're going above 50 million, your fee is probably going to 1.5 to 2%. If you get up to 100 million, the fee is probably about 0.75 basis points. And it could even be lower depending on the work that was actually done on it.
Right.
But but the scale on those things can, vary significantly on that. And we're looking for assets that we can find a lot of, really. And, if you're working on stuff that's only, 100 million and up, well, you're just going to find there's fewer in the market.
Yeah.
And more people involved.
Yeah. Yeah. I mean, if you go like on a good data source, like CoStar or Reonomy is another one that we really like. And you can do a search on properties between 5, which is your low end commercial unit count, to 50 or whatever you want to look at. 10, let's say you want to start at 10 units and go to 50 and do a count on how many properties are available in your particular market that you're looking at, or that you're interested in, or that you're already in. There's going to be way more properties in that size than there will be 150 plus units, which is like,
and even more if you add in fourplexes.
Oh yeah. If you go fourplexes, duplexes, then you're really talking a lot of inventory to choose from, for sure. We really have enjoyed being in the commercial space after being in the residential space for as long as we were, and so we really try to stay in the 5+ unit count. But we've really changed our thinking as we've grown our roots in the 2 markets that we're in, because now we have infrastructure and teams and partners in place that can handle multiple properties and CapEx and turnover and whatnot.
You have the systems in place now.
Yeah, we've got the property managers in place and everything else. And so thinking about doing a 20 unit or a 30 unit or 15 unit or something like that is a lot more likely than it was 6 months ago even.
Do it. Inevitable.
Yeah. And like you said, I mean, you want to get masterful at something that there's a lot of opportunity for. And, it's one of the reasons we love Columbus and Oklahoma City, just because there's a fair amount of inventory, and especially in Oklahoma City and Oklahoma tertiary markets, there's a lot of larger scale Class C. And so we've gotten very comfortable there, but we would do a smaller deal because, like you said, there's a lot to be said for staying within what you're capable of doing yourself, assuming that you're capable of doing something like 2 million to 15 million. When you're starting out, that's not possible. So you got to partner up and leverage up. And
the partnering and the leveraging, what's interesting about the scaling up is, the one thing that I love about real estate is it's such a team sport industry. This podcast and, what you're doing to be out in the community of investors, it's really important, and as I'm sure that, you want people to reach out to you. We want people to reach out to us. There's a lot of guys out there and they have some building and hey, there's this building. I know about it. I want to figure out how to take this down, and it varies by niche, and I talk about this on my website where there are niche industries for entitlement, for development, for core plus, for core, for value add, and that goes over every product type within real estate. And there are many professionals that will partner with guys to say, hey, you know what, let's work together and let's, I see you got this building, you're bringing in the value because you got this opportunity. We can bring in value because we got this capital source. And, and those are ways to, truly more quickly augment some learning experience, so that someone who does have, I've got a buddy who he's been flipping houses this year. He just tied up maybe a month ago a 6-unit building in Cincinnati, and now he's doing a 21 unit in that same city. And he got his first one under him. He figured out how to get his contractor set up and all these things, and he kind of said, "Wow!" And he had already known he knew how to flip houses. He'd been flipping houses for a while. And when he saw the 6-unit, that was originally just going to be for him, for his own investors. And then when he moved up to the larger property, he had enough experience under to look at it and go, hey, I can assess this. I can figure it out. And I was going to say proud of him, but I am proud of him. I mean, he's just growing his portfolio just so rapidly, and he's leveraging with guys and learning from other guys, with how to do this stuff. And he called me up and, I mean, I felt great to be able to have him call me and have him be able to take him through what numbers should be capitalized, what numbers shouldn't be capitalized, what numbers we, should remove from the owner's expenses, and which ones we should carry forward. But I mean, he won't ever need that conversation again. He's just doing so great already. Mm-hmm. But within the industry, it's the quote. The road to success is littered by small successes. Okay, and the point is that you do the small things, you keep doing them, you have these successes, and they lead to bigger things, and so all those successes really add up to bigger successes. And and within real estate, that team effort and that team win, there's not many other industries like that. When you've got an industry in real estate, you got a seller who wants the deal to go through, you got a buyer who wants the deal to go through, you got a lender who wants it to go through, you got investors who want it to go through, you got brokers who want it to go through. When you close on a deal, everyone really has that big team camaraderie, and it's great, and that's the reason, and it's the same thing on the side of all the people who partner together to make transactions work. And those are the things that I love about the industry.
Yeah. And listeners, again, like if you resonate with what Max just said in terms of teamwork and enjoying, like really thriving inside of a team environment, then this space is probably a good one for you. And if you're doing the solopreneur thing, like there's nothing wrong with that. And I know a lot of house flippers and wholesalers and those type investors that do the solopreneur thing, but I don't know really anybody that's doing high level commercial multifamily that doesn't have a really good team and isn't partnering with really solid people.
Yeah. The larger you get, the more people you have to have involved.
Yeah.
Yeah, you really do.
Yeah, and your team grows. Like we're hiring a operations coordinator right now, and internal operations coordinator. We'll probably be hiring an asset manager at some point as we grow our portfolio. So you guys and your team, how long have you been at it together at this point?
Just about a year.
A year. Okay, cool.
Yeah, just about a year. And and we're working through and a lot of this year, to be really honest, has been built on the capital raising side. It really has. Mm-hmm. And that's been fine. We've been working through that. My business partner just sold a building in Los Angeles, and and then we're working through other deals, right now. But it's definitely been a year that we've had to truly establish the capital side first, prior to really going out and then understanding the market. And in this market, to everyone who's looking at deals, I mean, this year has been a very new experience for everyone in the industry everywhere. Yeah, it really has. It really has. I mean, this year has just been so absolutely just wild in regards to where we've seen pricing go and how aggressive the bidding has gone just for everyone. It's just been really, really crazy.
Who saw that in March of 2020? Like,
we all have these deals back in March of 2020. We all have these deals, that we're working on going, is the market going to go the other way? Yeah. And, 2020, even into 2021, I mean, there were deals that I didn't think the market was going to continue going the way it did, even this year. Yeah. And they just kept moving.
Yeah. And I mean, at the very least, we thought there'd be some sort of COVID discount, right? Like there'd be short term up, like bad collections for 6 months kind of thing. And it would force the overcapitalized guys out and put their product in the market. That never happened. Like
I know guys right now who have not bought a thing and they're still holding their breath for that COVID discount. They still think it's going to happen. And, and I don't see it. I don't. I mean, I
don't either.
Yeah. I mean, and there's a couple of reasons for it, and talking very specifically about, the market across the board, and I was in the market in 2008 when things were really crashing. Mm-hmm. It was a horrible experience. I hope that never happens again. People talk about it like it was an economy, like the real estate corrected. And the answer is the real estate didn't correct. What occurred was there was a liquidity crisis where all of a sudden, no one could afford to buy any properties because debt had been completely removed from the market.
Right. Right.
And that was combined with, loss of jobs. And that loss of jobs, unemployment, was all of a sudden what caused collections to drop and then have so many properties go back to the banks during those years. Mm-hmm. Right now, we're not seeing that.
Right.
We are not seeing some massive unemployment on a national scale. And we also saw, rents fixed for all of 2020, where owners were not, raising the rents during that period of time. And now we're seeing, there be this massive amount of new influx of capital into the market. I'm sorry, the stimulus that's gone out that's really decreased the value of the U.S. dollar.
Right.
And then we've caught up from really 2 years of inflation that were there prior. So we've got 2020 and whatever rent bumps we're going to be coming up that year, plus the 2021 year, plus this additional factor of new cash in the market. And these are the reasons why we're seeing such national rent increases across the board. Which I'm not really an advocate of. Raising rents within the market is unfortunately somewhat of a factor of the fact that the only way to make a business run is to slowly increase rents. It happens on a market basis. One new owner comes into a market and they had to stretch to buy the building. They had to push their numbers. They had to put down hard money. They had to do this construction plan to get rents to a higher level, and they had to do that to pay back their capital. And as a result of doing that, they had to also raise rents to be able to make those numbers meet. And those factors, while for one individual building might seem like one thing, but that then trickles out to other buildings. Other owners then trade out of their buildings. They use that building as a data point, and rents slowly go up over the course of time. I am not an advocate of fatiguing the rental market on a national basis, which is also what we're going to find out here. I mean, rents going up nationally. I've heard a lot about incomes moving up nationally, and we'll just find out where those actually go on a national basis. And I'm very interested to find out what that looks like.
Mm-hmm. Yeah. What's your crystal ball look like? Is that a fair question on a podcast?
My crystal ball is that real estate is a short supply product. And the value of real estate is going to continue to go up forever.
Yeah.
I mean that forever. And the supply, the construction materials are never going to go down in price. We are never going to have a new glut of available supply that's going to come back on the market. We are still some 15 million units short nationally on housing supply.
Yeah.
1 in 4 new homes is bought by some kind of corporation that is not going to sell it back to the market. They are buying it for the permanent purpose of having it be a permanent rental. Mm-hmm. And you've got new home construction where, there were a lot of companies previously used to do master plan developments in communities. Those companies still exist, but a lot of the new supply that's coming out are built in build to rent communities, where you've got an ownership group that's building 100, 200, 1,000 units within a master plan community. And they're not selling them one-off to individual families who want to have their kids grow up in this neighborhood. They're selling them as build to rent communities. And 20 years from now, there will be entire communities that are separate detached homes in one particular area that are being sold just the same as apartment buildings are today. And when I was talking earlier about saying, oh, well, that's a early 2000s build or that's a 70s build, eventually in 20 years from now, they're going to say, oh, that was a 2022 build of builder community that's all detached homes and in this particular complex, and those will be what will be sold in 20 years from now as what I'll call a core plus investment, right, at that time.
Yeah.
But my point is that the supply of real estate, when you've got new supply coming out, and it's not even for people to own for their personal home, just indicates the shrinking nature of how important home ownership really is, because the supply is being taken away.
Yeah.
And that's going to continue to increase the value of the real estate. And then we're going to see that, the cost of new construction continue to go up. So crystal ball, buy real estate, capitalize it well. When I say capitalize it well, make sure you don't ever lose a property back to a bank based on good financing and underwriting. Make sure that the underwriting, matters and it's been done in a detailed fashion. And work with professionals who have local niche market knowledge within an area to be able to augment those portfolios. So a lot of guys within real estate, real estate's touted as a passive investment. Not in my experience. It's pretty, it's something that you still really have to have spend time and resources doing.
Absolutely.
And and partner with guys who are doing it. A lot of guys go, oh, it's too much time for me to invest in real estate or look through deals, and they don't realize what kind of returns they can get with working with a green light or a geometric real estate.
Mm-hmm.
So reach out to the guys who are doing it. To any listeners, educate yourself on what those offerings look like. You get partnered up with these guys, you'll learn more about the offerings, you learn about how they do it, you learn about how they structure things, and no one will ever be upset that you invested in improved your knowledge of the market and how the whole process works.
Yeah. So again, like the LP option, guys, is really a good one, and it's a great way of getting into this space. LPs get paid first after debt service and expenses, they get paid first, and they get paid the most at the end of the day, compared to the general partners. And so
I just did this calculation for someone, and I didn't realize that I was in a Lyft actually in Las Vegas, and driver's there, and we had a similar conversation. I said, hey, you need to buy a home. And he goes, I can't do that. And I goes, what are you paying for rent right now? And he goes, $1,200. And I'm like, you have a roommate? And he goes, yeah. What's he paying? He's like, it's the same.
Wow.
Like, okay. All right. So the two of you need to immediately, I was like, is he buddy yours? And he goes, yeah. You trust him? He goes, yeah, absolutely. Okay. You guys need to go buy a house, right now. And he was like, well, why? Why should I buy a house? I don't get it. And I literally said, all right, look, you're spending every month, that rent you're paying is going down the toilet to rent. And don't get me wrong, we provide a service of shelter for everyone who's our renters. We try to provide, the best living accommodations we can. But, I said, all right, look at this. If you're spending $50,000 as an investment right now, if you put away $50,000 today at a 10% return on your investment, which is very real within the real estate market, for 30 years, in 30 years, you'll have $872,000 saved. That's on one $50,000 investment.
Yeah.
Rolled over 10% a year for 30 years. So for investors who are out there and they're saying, hey, you know what, I don't know how to get into real estate, you've got some money to invest. I mean, it's important, it's important to have that money, put away and growing, because, it's Robert Kiyosaki, his comment, money is worth less every following day, the money is worth less because they're printing more of it, and they can't print real estate that fast. So, it's important to always be an investor. It really is.
Yeah. And it's amongst other things, it's a hedge against inflation, which you just did a pretty good job of indirectly explaining. You kind of hit on that. Like, as the value of the dollar goes down, the value of your asset relative to that basically stays at the same level as where it was when you bought it. So those dollars are larger dollars than the ones that are out in the market. You explained it a little more eloquently than me, but
we're on the same page.
Yeah. So, awesome. So how do people reach you and find out more about you and your company?
Yeah. Website, geometricre.com. And would love to connect with anyone who wants to connect. I talk to investors from all over the country. If you're interested, you want to have a conversation, reach out. I'd love it.
Yep.
And that's the best way.
Awesome. Love it. Geometricre.com.
You got it.
Okay. There you go, listeners. This was Max Gonzales. Max, this was fantastic, man. I got so much out of this. I've got notes in front of me, and I feel like this was a great learn. Do you have any, again, to the listener that's kind of like in the feeling around for different options kind of space, like my dog is chiming in right now on my side. I just had lunch today with this guy who's like, I'm thinking about mobile homes, and I'm thinking about RV parks, and I see what you're doing with apartments, and like, what would you say to somebody that's kind of like feeling into what they want to do here and how they want to move forward?
Just jump in.
There you
jump
go.
in. I mean, you're going to make mistakes to any investor, and this doesn't. I mean, the reality is that never ends. I mean, the longer you're in the industry, you're going to make more mistakes. And, luckily with real estate, mistakes are, they happen, but you're talking about a long-term performing asset. And for the most part, I mean, they're I don't want to say expected, but they're expected. I mean, they're just gonna happen. You're gonna learn new things on every one of them. And and when I say, jump in, or they got a mobile home that they want to figure out, you can find mobile homes that are, I got a call from a postcard on a property in, I think it was Tucson, Arizona. It was for a 5-unit mobile home park for a little under 200,000. We don't focus on mobile homes, but, for someone who wanted to get in, I mean, these opportunities are out there, and a lot of guys, figure out how to work through those things. And, and my real answer is, YouTube, partner with guys who do mobile home parks. I don't have a fantastic background in mobile home parks, and I actually would love to learn more about them, because I know you're supposed to capitalize the land and not the actual individual mobile homes themselves as a result of the way that the assets are run, and I understand the process behind that. But there are lots of guys out there who can teach you how to work with getting that money in there, working with a seller to have him carry back paper, working on some kind of a plan where you'll manage it and do an option to purchase it within a couple of years. There's a lot of ways within real estate to I'll call it structure your own future, and not to be scared of that. And a lot of guys are, well, I don't know how to do this, or I got some fear about this. And the answer is, hey, you got to figure it out. And real estate, luckily, is this industry. It's not, and there's no other industry like this, where the deal is whatever you structure. And you find a seller who says, hey, I'm willing to carry back paper. Hey, I get it. Your income is not where I want it to be, but you can live in this one unit, and you're going to carry paper. So I know you're going to be here on site. And I'm making up a scenario, but
sure.
But within real estate, there are ways to work through issues, and there's books, there's YouTube, there's podcasts like this, and there are people who are very open to partnering with people who want to figure out how to make stuff work. There just are. And got to be solution focused within real estate. And there are solutions, there are ways to work through it, and get good at a market. I'll say that, if you want to be, the only way you're really going to know if an opportunity is a good opportunity is to really start evaluating a lot of them. That's the best thing, and to be niche in the same and where you're looking, and hopefully use the same model. You're not gonna be able to compare mobile home park to apartment community, or to a gas station, or to any kind of other property use, because each one of those is going to be its very own individual business model, and return for what that business model takes to run and operate. And once you start learning about any one particular niche, mobile homes, well, then you can start comparing them against each other within a local market. And once you can start doing that, that's where value really starts. You're going to be better at identifying value. And then, you can start working with an ownership group to try to figure out how to buy it.
There you go.
So guys, that's my advice.
Love it. That's a recipe for success right there. Good stuff. So structure your own future. That's a good one. That might be the name of the episode right there.
I love it.
Yeah, it's good. That's a good stuff. Great.
All right, Tate, I'm going to, this has been really fantastic.
Yeah,
I really appreciate you having me on, and,
thank you.
Yeah, call me anytime, and would love to connect. And that's it for today.
Yeah. Appreciate it. Yeah. Listeners, thank you for listening to another one of these episodes. We appreciate it. If you feel so led, leave a rating and review. It means a lot to us and helps the show. And Max, I really appreciate you being on, man. This has been great.
Absolutely. Yeah. Tate.
All right.
All right. Hey, have a great evening.
Take care. You too. Take care. Bye-bye.
Thanks for listening to The Apartment Guys with Tate Seamer. Tate and friends are grateful to have you as a loyal listener. If you like what you've heard, please subscribe, rate, review, and share with friends on your Apple Podcasts, Google Play, Spotify, or any other podcast platform. Also, check out Tate's YouTube channel for videos of many of these episodes and more. Until next time, take massive action steps and rock on.